Well, if our top story is any indication, we're in for another bumper profit round for the Big Four. They're hot stocks right now, but will things stay that way? Well, I'm joined in the studio by fund manager Roger Montgomery. Roger, welcome.
Thank you, Ticky.
Well, here we have Mike Smith today declaring that the ANZ results demonstrates the bank is firing on all cylinders, and the share prices of these banks in the last 12 months have just gone through the stratosphere.
Well, the last time we spoke for any length about the banks was in late 2011. All of the banks were trading at slight discounts to our estimate of their value. They're now at reasonable premiums, so they're expensive again. And what's interesting about this result is that the profit figure has gone up. The return on equity has only gone up by about 20 basis points, so that the change, the increase in the value from the improvement in the profitability is minor, but the decline in the intrinsic value to the ANZ from the increase in the payout ratio is much greater. So on a net basis, everyone's bought the shares and bid the price up, but the value hasn't gone up as much.
And the reason they're piling in to these stocks?
Well, that's obvious. It's on a relative yield basis. So interest rates are low, and we just heard Glenn Stevens talking about property prices and confidence. Interest rates are low. It used to be that if you saved up $1 million over your life, you were set for life. And now you put $1 million in the bank, you're earning $30,000 a year. It doesn't feel like you're a millionaire with $1 million. So people are looking at the stability of the dividends that come from the banks and are feeling comfortable about that. But my warning is that it's a false sense of security. You don't invest successfully in the share market by chasing yields. You've got to buy businesses below intrinsic value and sell them if they go too far above, and they're reaching that point now.
So we've got this good dividend stream, we've got a share price going up. Today, the ANZ increased dividends.
Yes, so what happened is the payout ratio has been increased to just shy of 70%. But just like
That's
a bank...
pretty high.
Yes, it is. Think about two bank accounts that have $10 million each in them earning 20%. One bank account you're required to receive all the interest, so all the interest is paid out. The other one gives you the flexibility of reinvesting that interest and compounding it. Clearly the one that compounds the interest is worth more. If ANZ increases its payout ratio, the part of the bank investment that retains and compounds is smaller, and so it's worth less as a result.
How are we doing globally? How are our Big Four banks doing compared to the rest of the world?
They are pigs in mud. The banks here have it made. They have a very, very comfortable oligopoly, and for that reason, we saw during the GFC, yes, their share prices dropped, yes, their profits came off a bit. In ANZ's case, it went back to where the profit was, I think, about $3 billion back in 2005 or 2006. But since then, we've seen it recover tremendously.
But you're not expecting much to happen, obviously, from the financial services inquiry. I mean, I've just been at the COBBA conference this morning for the mutuals and the co-ops, and got people like Stuart Grimshaw, Bank of Queensland, saying how much more capital he had to set aside in order to lend for a mortgage. But you don't see much happening out of this?
I am concerned at the moment that what we're seeing is the mass market all believing that they're going to make their riches out of property again, and that's the first seed that's always planted in a bubble. Now, there isn't a bubble at the moment, but when people start being unconcerned about the income from a property and all they care about is that the price is going up and they're going to miss out, well, that's the germination of a bubble, and banks should be worried about that.
But that's presumably where the growth, if there is growth to come, is going to come from.
Well, a lot of the growth, a lot of the increases in profits from the banks has been because of the reduction of bad debts and provisions for bad debts, and we're not seeing big increases in confidence amongst business, and that's where we've got to see credit growth.
Or retail.
Exactly.
So really, it's quite difficult. And finally, you can only find 4 companies in the top 100 as good value. What does that say about the market? I
am concerned, and it's not often I ring the bell, but I'm ringing the bell now to say out of the top 100 companies, we can find 4 that are cheap, that we believe are cheap based on estimated intrinsic value. Yeah. That's Fortescue Metals, JB Hi-Fi, Orica and Leighton's. But before you go out and rush and buy those, there's 96 that are expensive.
Yes.
So the overwhelming weight is that the market is expensive, and so I'd be very concerned.
Roger Montgomery, always good to get your views. Thank you very much.
It's a pleasure, Ticky.